Hello friends, this is Rupinder from Edu Pristine. Today's webinar is mainly about FRM demo. In this webinar, we will start with Outlook on Edu Pristine, then details about the FRM classes offered by Edu Pristine, and finally a demo lecture on Options Basic. During this demo and anywhere during the webinar, let me know if you have any queries. Do let me know if I'm going fast or slow. I will try to answer all your questions. In case any question is thus, and we will revert back with the answer. So don't worry, we will answer all your queries. Also, do keep in mind that this demo is online and it will be great if we can make it more interactive. So please shoot as many questions as you can. So to start, let's have a quick outlook on Edu Pristine. Edu Pristine is largest and authorized training provider for international certifications. We are authorized by CFA Institute for CFA training, authorized by GARP for FRM, for which this demo is Financial Risk Manager, authorized for CFA by FPSB, and authorized by Premium for PRM and APRM. We are pioneer and leader in skill-oriented finance courses, for example, financial modeling in Excel, business analytics, HR analytics. We offer 25 plus courses through classroom trainings, online videos, webinars, etc. We have provided more than 1 million man-hours of training to more than 10,000 finance professionals and students across the world. These students are from 40 plus nationalities. Our brand is trusted source of training. It can be seen as 60% of our enrollments are through references. Edu Pristine has delivered high quality trainings for various Fortune 500 corporates. These are some key associations of Edu Pristine. We have conducted a lot of trainings at E&Y. So we have conducted PRM training at Bank of America, financial modeling at JP Morgan, and various other big names. Not only big names, Edu Pristine have given trainings to the students of world-renowned institutions like NUS Singapore, IIM Calcutta, IIT Delhi, ISB Hyderabad, which is in top 20 of the world. We have global presence and online presence and existing classroom presence at Singapore, Middle East, USA, and India. We have partnered online with Bionic Turtle for operational risk modeling and Asymmetrics for the same operational risk modeling, and for Excel based courses with chandu.org. We have partnered offline with SHRI, which is Singapore Human Resource Institute, and Centosys Mauritius, where we have delivered trainings on CFA, FRM, business analytics, financial modeling, and HR analytics. Now about Edu Pristine's classroom course. It is a 6-day extensive classroom training in which first 2 days we will be studying about quantitative analysis. Then we have 2 days for FMP, which is financial market products. We have 1 day for valuation and risk models, and on the last day we have VAR, which is value at risk and foundations of risk management. Along with these 6 days, you will get access to our online training, which is for 50 hours spread over 10 days, basically 5 hours a day. The best thing about Edu Pristine's training is that it comes with 100% money back guarantee. 100%. You will also get access to our FRM Pro package worth $397. There will be 2 full mock tests for you to see how you perform and topic-wise question bank so that you can practice once you complete one particular topic. Every candidate will get 60 minutes of one-on-one doubt clearing sessions. In case you have any doubts, you can resolve it in this session. Not only this, you will also get access to discussion forums where you can interact with faculty and students and get your query resolved. 15 hours of summarized videos will be provided to you for quick revision. For quick revision, you will be provided with visualized FRM chart. So I'll show you visualized FRM chart sample in a minute. In this, if you make this handy, it can be of tremendous help to you. You can keep these with you and go through them quickly. Let me show you first. So this is one of the example of visualized chart. So you can see it, everything is summarized on one page. So if you keep it handy, and let's say you keep it in your pocket, and while you're traveling or going anywhere, you have time for 5 minutes, so you can quickly go through them. And as you know, practice makes a man perfect. You will understand these concepts like anything. Now, there will be online revision classes where we will be discussing FRM practice papers for 2010 onwards, which are provided by GARP. This is just to understand what kind of questions you can expect in the exam. You will be reviewing the key concepts and receiving exam tips just before you take the exam. So this is the package what you will get when you enroll for Edu Pristine's classroom training. Now let's start demo for options basics. We will not be covering everything. We will be going through main parts of the option basics. So do let me know in case you have any doubts. Now, to start discussion, basically we will first study about what are options. Now, what the little mean or layman language meaning of options? Options is nothing but it's a right, it's a choice to do something. That's an option. Similarly, in financial world, it's a choice to do something. And what we do in financial world, we buy or we sell. So it's a right to buy or right to sell. Now, what kind of options we have? So it seems that mainly we should have two kind of options. One should give us a right to buy, another should give us a right to sell. So we have two options, main options. One is called call option, another is called put option. Now, call option is nothing but right to buy. So when you have right to buy at a fixed price and at a particular time. So it can be particular time during a particular period of time. You have the right to buy at a fixed price. That is called a call option. So let's say I have a stock which is right now worth $50 and I buy a call option. Now in call option, I agree to buy at $50 after, let's say, 3 months. So after 3 months, if the price is at $60, I have the right to buy at 50. So I can buy at 50 and sell at 60. So I'll make a profit of $10. But if I have, let's say my stock goes down to $40, what I have? I can buy at 50, but the market price is 40. So will I buy at 50? No, because that is a higher price. I can always buy in the market if I want to buy at 40. So I will not exercise my option. So this is called expiring worthless. So my option expires worthless. I will not exercise my option. So if I want to buy, I can go directly to the market and buy at 40, not at 50. That is call. Now put. What is put? Put option is nothing but it's right to sell. What is right to sell? Basically, if let's take similar example, current stock is 50, I agree to sell at 50. So if market price goes to, let's say, $60, shall I buy at 50 or shall I buy at 60? I can always sell at 60 in the market, but shall I buy sell at 50? Sorry, shall I sell at 50? No, because I can sell at 60 in the market. So I will sell at 60 in the market, not at 50. I will not exercise my option. But now if my price goes down to 50, which was another example in my call option, so I can sell at 40 in the market, I can sell at 50 with the option. So where should I sell it? I can sell it at 50. I'll make a profit of $10. So in call, if market price goes up, I'll make a profit. So because I have the right to buy, so everybody of all of us would like to buy at a lower price. So if I agree to buy at 50 and market price goes to above 50, so I'll buy at 50. So it's good for me. And the opposite applies in put option, because I have the right to sell. So all of us would like to sell at a higher price. So I will try to sell at higher price. So I would like the stock price should go down. So if I have bought at 50, so I agree to sell at 50. So bought at 50 means that I bought a put option which I agree to sell at 50. Okay, so I bought the put option where I agree to sell at 50. So if market price goes to 40, then only I will sell. So I'll make a profit of $10. That's the basics of options. So basically, that's one is call option, another is put option. Now there are two kinds of options based on how you can exercise it. So one is called American and another is called European. Okay, so the name doesn't have anything to do with this, it's just the names. Okay, so American is when you can exercise it at any point of time. So this is my timeline. I bought the option here and it is applicable till 3 months. So I can exercise in between at any time. That is American option. So it's not that I can exercise only at so exercise at any point of time. Now European option. European option is nothing but that I can exercise only towards the end. So this is my timeline. I bought the option here and I can only exercise after it expires. So expiring means the contract is over. So I can exercise only after 3 months. But yes, definitely I can close my position in between by selling the option. So if I want to get rid of my position, I can always sell it, but I cannot exercise it. So if it's a call option, exercising means that I exercise that I will buy at 50. Okay, so if let's say you are a seller of the option and I am buyer of the option and I agree to buy at 50 and market price goes to 60. So it's not expiry yet. So in between I want to get rid of my option. So if it's an American option, I have one of choices, I can always sell that option to someone else. Second choice is if it's American, that I can actually give you $50 and get the stock from you. So I'm exercising my right. Okay, so that's American. But in European, I have only one choice. I can sell the option during the period and cannot exercise in between. I can only exercise at the end. Okay, so that's European. So these are the main two kind of options on based of exercising. There's one third called Bermudan options. Now where does Bermuda lie? It lies between America and Europe. Okay, so this option is nothing but it's a combination of these two. Combination means that American European option is that you can only exercise at the end. American is you can exercise at any point of time. Bermudan is you can exercise at some times. Okay, so let's say every Monday you can exercise. So every week, once a day you can exercise. So it's not American that you can exercise at any point of time. It's not European that you can exercise only at the end. It's Bermudan. It's a mix. It's lie between in between European and American that you can exercise on some dates. Okay, that's Bermudan option. So that's the basic of options. Is it clear? Any doubts till now, guys? Let me know if you have any doubt. Okay. Now let's try one question. Though we have not covered any concepts, but let's try a question so that and try to understand the concept behind this. Can you please read the question? And can you please try to answer this? Now we will not apply any theory, we will just apply logic. So what the logic say? You know the definition of the options and we'll try to see with the logic what can be the answer. Now this is a previous exam question, so you can expect these kind of questions in FRM. Now the question says early exercise. So early exercise means that it's a you can exercise in between the time. So your option starts here, it expires here. So early exercise means you will exercise somewhere here. That's early exercise. Okay. So early exercise of an option is more likely for. Now we just discussed that European options are those options which can only be exercised at the end. So early exercise of a European option, is it possible? No, because it can only be exercised at expiry, and American options can be exercised in between. So A option cannot be answered. So we are left with 3 options. Now do keep in mind that there is no negative marking. So even if you don't know the answer, please don't leave any question. You can always answer it and you can have a chance to get the correct answer. Now always try to go for intelligent guessing. Intelligent guessing is nothing but removing what cannot be answered. Like in this, if we just guess it blindly, our chance of getting the right answer is 25%. But as we know, European call options cannot be exercised before the time of expiry, then A cannot be answered. Now we have 33% of chance of getting the right question. Okay, so I got one answer which says C. Okay, C says American put options deep in the money and close to maturity. Okay, that seems the correct answer, but why, may I ask if somebody can answer me? Why? So I got this answer from Ashish Ranjan. So before we jump to the answer, let's look at options, all options. So because we are trying to solve this, let's see what's the logic behind each option. Now it says American call options on stocks paying small dividends. Okay, now before we move, there is a concept of intrinsic value and extrinsic value. So there's option, you are buying an option. So do you think you can buy it without any money, or you have to pay something? So what happens is, if I'm getting a right to do something, so right to do something means I'm getting a choice. So in real life, if you are getting a choice, do you need to pay something, or you get the choice at free? That we get any choice free, it's always we need to pay something. Now that is called option premium, that you pay to buy that option. So if I am an option buyer, I'm getting the right to buy or sell, so I need to pay a premium, and the option seller gets that premium because he's giving you a right, he's entering into an obligation. Okay, because if you have the right to buy and when you exercise that buying, he has to sell it. So you are buying, he's selling it, he has to sell it, means he has an obligation. You have the right. So he's getting into an obligation by receiving this premium. You are paying this premium to get that right, and he is receiving this premium to get into an obligation. Okay, so this premium is made up of two things. One is called intrinsic value, another is called extrinsic value. Okay, now extrinsic value is also called time value. Okay, time value is because in reality, if I'm buying an option for 3 months, so in those 3 months the stock can go in my favor. So if this is an option on a stock, so for example, I buy a call option, so it means I have the right to buy at 50. So market can go below 50 and above 50. So let's assume market can go 50% chance going down, 50% chance going up. So what can happen? If it goes down, it's a loss for me. If it goes up, it's a profit for me. So it's a 50% chance of making a loss, 50% chance of making a profit. But what is my loss? My loss is my premium. So that is fixed. So maximum I can lose, let's say $3 is my premium. So maximum I can lose is $3. But how much I can make? I can make, let's say if it goes to 100, how much I will make? $50. If it goes to 150, I'll make $100. So there's infinite potential of making money on our upside. So my losses are fixed, my profits are not fixed, it can go anywhere. So my time value is usually, in most cases, almost all cases, it's positive, that you pay to have a higher time. So if it's 3 months or if it's a 6 month, which one is good for the buyer, option buyer? Obviously 6 months, because 3 months it can go to, let's say from 50 it can go to maximum 100, and if it's 6 months it can go to 152. So you can make more profit. So higher the time, higher the chance of moving from where you are standing. So let's say you have only 1 day, how much it can move in a normal condition? From 52, 53, 47, 46, and in 1 week 50 to 60, 50 to 40, right? In normal condition. In extreme condition, obviously it can go anywhere, but in normal conditions it can move higher with the higher time. So time value is higher for higher time. Okay, and intrinsic value. What is intrinsic value? Intrinsic value is nothing but what you will get in case you exercise it right away. Okay, right away means, let's say it's an American option, so it applies actually to both European and American. Okay, it's just a way to see that how a option, at what position an option is right now. So let's say it's a call and I have the right to buy at $50. Now this $50, this price is called strike price, or sometimes it's called exercise price, so at which I have the right to buy or sell. Right now the stock is at $60. Now if I exercise it right now, how much I will make? I'll make $10, because I have the right to buy at 50. Current market price is 60, so I can make $10 right away. So this $10 is called intrinsic value. That this value, this minimum value, I'll get if I buy this option right now and I exercise it right away, I'll get this $10 at least. That's intrinsic value, the value which is already there in the option. Okay, that $10, that is intrinsic value. Now if the market price is not 60, it's 50. What's the intrinsic value? 0. And if market price is 40, what is the intrinsic value? No, it's not 40, it is 0. It's not 10, it's not 40, it's 0, because you have the right to buy at 50. Market price is 40. Will you buy at 50? No. You can always go in the market and buy at 40, so you will not exercise it. So your value is 0. Okay, so I got a question from Ashish. It says spot price exercise option in case of call option, and exercise price spot price in okay, so correct. So spot price is the current stock price, so it is denoted by S, and exercise price or the strike price, sometimes people denote it by X, sometimes they are denoted by K. So it is S minus K if it's call option. So S means strike price, stock price. So if it is 60, it's 60 minus 50, which is $10. Okay, but if it's 40, it's 40 minus 50, which is minus 10. So this is not my intrinsic value in case I'm talking about negative intrinsic value. So there is a function max 0 comma S minus K. So if this is positive, that's my intrinsic value. If this is negative or 0, my intrinsic value is 0. Okay, so this is in the case of call. Okay, so I will not exercise, or I will get the 0 intrinsic value in case my stock price is lesser than my my exercise stock price is lesser than my strike price for call option, and the reverse for the put option. Now this is intrinsic value. Now if you have a positive intrinsic value, this is called in the money, that you are already making some money, that's in the money. If it is negative, so actually it's 0, it is called out of the money, that it's out of the money and you need extra movement to make it. Yes, this is known as intrinsic value. Now 50 minus 50, so stock price or spot price is equal to my strike price. What is this called? This is called add the money. You are studying add the money. So this is add the money, in the money, out of the money. So you should know what is in the money, add the money, out of the money. Okay, now it says, let's go to the option, American call option on stocks paying small dividends. Now it says that you can exercise if it's a call option and it's a paying small dividend. Now as we discussed, premium you will get if you sell, or if you pay, if you buy, it's always sum of intrinsic value plus time value or extrinsic value. Now intrinsic value is what you calculate. Now if the stock is paying a dividend, now if a dividend is there, what will happen to the value of the stock? Will it go up or down? Now first of all, we don't know if our option is in the money or out of the money. So if it's out of the money, there is no chance that we will exercise this. Okay, and if it is in the money, then we can think of, but not always. It's not TN, sorry, it's time value. So, pardon my writing, it's time value, TV. So this is intrinsic value plus time value. Okay, time value is basically extrinsic value. So how much time it's left, how much volatility. So there are several factors which define time value. Okay, now so if it's a small dividend, let's say the stock price is 50 and it offers you, let's say, not a small dividend, let's say large dividend of $5. Okay, what will be the price? What happens to the price? Price goes down, because then there will be outflow of money from stock, the value of the stock will go down, so it will go to 45. So you have the right to buy at 50 and the current price, let's say it is 60, and there is a $5 dividend. The price will go after the dividend to 55. Now 60 is good for you or 55 is good for you? Obviously 60. You can buy at 50, you can sell at 60, you will make $10. You can buy at 50, you can sell at 55, you will make $5. So 60 is good for you. So you don't want higher dividend or dividend at all, right? So in case there are dividends in stock options, okay, you don't want those. So what you can do is you can early exercise just before the dividend. So you will exercise just before the dividend because you don't want this drop in the price, because you don't own the stock in case you don't exercise. So $5 you will not receive, somebody else will receive. So you want to exercise before the dividend at 60. But you will only go for this if this is a large dividend. If it is small dividend, you don't want that, because small dividend will not affect your price that much. So in this option, one, we don't know if it's in the money or out of the money. Second, it's a small dividend. So small dividend we don't mind because there will be hardly any effect. So let's say it goes to 49.8. So 49.8. So there is hardly any difference. There will be higher charges for exercising. So I'll keep my option. So I will not exercise this. Okay. So B option cannot be answered. Any doubts in the B options? Okay. Now somebody answered C, so I will not check C at this point of time. I'll check D first. It says American put options on large dividends. We just checked large dividends are good for call, good in the sense that you can exercise just before the dividend. Okay. Then you will exercise it if it's a large dividend in call, not in put, right? Let's check what happens in the put. Now in put, again the same story. If the price is 60 and let's say you agree to sell at 70, okay, the price at 60, and if there is a dividend $5, the price will go to 55. Now you have the right to sell at 70. So 60 is good for you or 55? You have the right to sell at 70 and you can buy at 60. So how much you will make? 10. You have the right to sell at 70 and you can buy at 55. You will make $15. So you want this dividend to happen in the market. Okay. Now this dividend is good for you. So you will wait for this dividend. You will not exercise this before this dividend. So you will not early exercise. So in call, if it's a large dividend, you will early exercise. But in a put, if it's a large dividend, you will not early exercise. You will wait for the dividend and then exercise. So there is no early exercise with the put with large dividends. So this cannot be answered. Okay. Hope you understand. Now, so clear choice is C, but we will discuss. Now somebody said American put options deep in the money and close to majority. We will clearly exercise this because it's deep in the money. But if I give you an option with American call in the money, so in the money the short form is ITM, out of the money is OTM, and at the money is ATM. Okay, so American call in the money, tell me, will you exercise? I think the answer was given by Ashish. Can you tell me, is there any difference between in the deep in the money put option or deep in the money call option? So if instead of D there's another option named American call deep in the money and close to majority, so will you answer C or D? Now there is a difference. We just discussed in B option that call options with small or no dividends we will not exercise even if they are in the money. Okay, but if they are large dividends in the money call, then we will exercise it. Okay, so this cannot be option. Let's look at this. Now let's say you agree to sell at $100. Now deep in the money is that market price is lower than 100, so 90, 80. Deep in the money is it's too much in the money. So let's say market price is at $10. So you agreed to sell at 100 and it's at $10 right now. So you are making how much? $90. Okay. So I got an answer which says we will exercise deep in the money option over in the money option. I partially agree. Why? Because if it's a call and it's a call deep in the money, even then we will not exercise in case there are no dividends. Okay, so there's a full theory which we will not get time today, but in case we meet again, then we will discuss that why deep in the money call options without dividends is not a good choice for early exercise. Okay, it's only put option. Deep in the money we will exercise. So if there are no dividends, condition is that. Okay, so in this example we have the right to sell at 100 and current price is $10. How much you are making? $90. Now how much more maximum you can make? Maximum this stock can go down till what? 0. So you can make how much extra? $10. Okay, so $90 you are making and maximum you can make $100. Now do you think going to 0 or going to 20 and above, which is more probable? So if it goes to 0, it has to bankrupt. Bankrupt means 0, nothing should be left, right? So it's a very, let's say, rare case in any company's case. Okay, so going to 0 is a very difficult situation. Going back from 10 to 20 or 30, it's not that difficult. So the probability of going from 10 and above is higher than going from 10 to 0. So even if it goes from 10 to 0, you can make only 10, but if it goes from 10 to 20 or 30, you will lose in the sense you will make less. Right now you are making $90, then you will make $80, $70. So you can lose everything which you have made. So maximum you can gain $10 and you can lose $90 which you have already made. So would you like to keep this with you or get rid of this? If I'm into this condition, I will just close this position and pocket the money. Okay, so I'll exercise this, keep the $90 with me, because the potential left is very less. So it's just the logic I'm applying. What is the potential left? The potential left is $10, and what I have made $90. So I will keep the money and go away. Right now it's a call option. Call option deep in the money means that you agree to buy at $100 and right now the market is at $200. Okay, so you're making $100, but how much more you can make? You can make in binary. If it goes to 400, you'll make 300. If it goes to 500, you'll make another 300. So there's potential left in call option. So in case it's a call option without dividends, you don't exercise it because you have potential left. But if it's a put option and it's deep in the money, the potential left is very less. So only $10 in this example you can make. So what you will do, you will try to get rid of the position. You will exercise this. So our answer is C. Hope this question clears many of your logics, concepts behind the options. Any doubts? So everybody agrees the answer should be C. Any doubts in this? Okay. Now, before we move, first we will see another question and then we will discuss one more thing. Okay. Now, read this. Can you please read this? Please let me know if you have any questions. The question says, assuming the stock price and all other variables remain the same, so nothing is changing, what will be the impact of an increase in the risk-free interest rate on the price of an American put option? Now, as I mentioned earlier, that there are several variables on which an option price depends, basically the extrinsic value. So it can be time, volatility. So the main variables are strike price, stock price. So the strike price at which you agree to buy or sell, stock price, so current stock price at which you want to exercise, at which you will exercise basically. Okay, then we have volatility, sigma, then we have interest rate, then we have dividend, okay, then we have time. Okay, so these are the main variables on which an option price. So option price is nothing but the premium you will pay or receive. If you buy the option, you will pay the premium, and if you sell the option, you will receive the premium. Now it's asking about put option dependence on risk-free interest rate. So basically interest rate. So if interest rate goes up, will the option price, put option price will go up or down? So it's a positive relationship or a negative relationship. Anyone who can answer me or try to answer me, please apply the logic. Now, what is a put option? What is the basic definition of put option? It's a right to sell. You have the right to sell. So when you sell, what happens? You receive money. So what you are doing, if you, so you have a stock, let's say right now with you, and the current price is, let's say $50. Okay, it's a $50 and you agree to sell at $50 only after 3 months. Okay, now you have a choice, you want to sell. So one thing is you go to the market and sell it now and you will receive $50. Another option is you buy a put option and you agree to sell after 3 months. So what you are doing, you are selling now or you are delaying your sell. So if you buy a put option, you are actually delaying your sell. Okay, so if you sell now, you'll receive $50 now. If you sell after 2 months, it's an American option. You can sell during like these 3 months anytime, but it will not be today. So it means you are delaying your sell. So if you sell now, you will receive $50 now, and if you sell after 2 months, you will receive $50 after 2 months. Now, if its interest rate is high, okay, if interest rate is high, can you tell me one thing? Would you like to deposit it in a bank? So if a bank gives you 10% interest rate, it's high, okay, and if it gives you 2%, in which condition you would like to deposit in a bank? Obviously it should be 10%, right? So if interest rate is high, you would like to deposit in a bank because you will receive a higher interest rate. Okay, so if interest rate is high, 10%, you would like to deposit it. So if interest rate is high, earlier the more time you deposit the money, higher interest you will earn. So we said if you sell now, you will receive $50 now, and if you sell after 2 months, you will receive $50 after 2 months. So if interest rate is high, would you like to deposit now and earn for 3 months, let's say, or you want to deposit after 2 months and earn for 1 month? Obviously if interest rate is high, I will try to earn or deposit for as much time as I can. So in this option I can earn for 3 months, in this option I can earn for 1 month. So I will deposit for 3 months. So I would like to get the money now rather than later. So if it's put option, I will sell the stock now. I will not wait. I will not buy the option. So even second case is I need, if I opt for the option, I need to buy that option. Let's say that option cost me $3. So I need to borrow this $3, borrow, or if I have the money, $3. So if I need to borrow this $3 at a higher interest rate, so I'm not earning on 50, but I am paying interest rate also on these $3. That's not a good situation for me. So if it's a high interest rate, I will not buy a put option. I will go for a selling the stock now and depositing the money, which is $50 in the bank right away. So if interest rate is high, I will not go for put option. So it means put option prices, demand is going down, the prices will go down, and the relationship is negative. So if interest rates are lower, it's opposite, that I will buy the put option now, and it's a negative relationship. So answer is B. Any doubts? Any doubts, guys? If it's clear, we can move. Is it clear? Okay. Now intrinsic value we have already discussed. Now on the last topic we will discuss one more thing. Okay. Now many people confuses the selling of a put option with buying a call option. Okay. What is buying a call option? Buying a call option is right to buy. What is a put option? Buying a put option, it's a right to sell. Okay. Now if I'm buying a put option, it's the right to sell. The person who is selling the put option, what he is getting into. If I'm buying the put option and you are selling the put option, so I have the right to sell. What do you have? You have obligation to buy. Obligation to buy. So if I buy a call option, it's the right to buy. If I sell a put option, it's an obligation to buy. So there is huge difference. It's obviously it's buy. Many confuses this because many times it's basically we consider, okay, I'm buying a call option, so it's a right to buy. I'm selling a put option, it's all also a buy, so it should be same. No, it's not same. Okay, so buying a call option is right to buy. Selling a put option is obligation to buy. Okay, so they are not same, they are different, so be careful. So many times the question comes around these points only. Second example is buying a put option and selling a call option. So buying a put option is right to sell. Okay, buying a put option. What is selling a call? So if I buy a call, I have the right to buy. If I sell a call, I need to sell when the other party buys, so I have the obligation to sell. Obligation to sell. So buying a put is right to buy, selling call is obligation to sell. So again different. Both are sell, but one is right, one is obligation. So these two things are also not same. So buying a call is not same as selling a put. Buying a put is not same as selling a call. Keep in mind. So hope this is also clear. Okay. Then how the graph of a call option looks like. Okay. Now what is a call? Call is right to buy. Let's say I agree to buy at 50. I agree to buy at 50. So what will happen? When I will exercise? I will exercise when the market is above 50. So if it at 60, how much I will make? If it at 60, how much I will make? I'll make $10. So I will make $10. If it is 70, I'll make $20. 80, $30. So I'll keep on making once it is above 50. If it is at 40, how much I will make? 0. If it is 30, how much I will make? 0. So the graph is like this. This how much? What is this? This is nothing but the premium I paid. So I paid, let's say, $5. So if the market is at 60 and I agree to buy at 50, how much I am making? I am making $10, but that is my payoff. Payoff is what you receive without considering what you have paid. Okay, so if I agree to buy at 50 and the current market price is 60, my payoff is $10. But what is my return? Return is 10 minus what I paid, so premium $5. So my profit is or return is $5. So this difference is $5. So my break even starts at 55. I start making my payoff starts at 50, but my break even is at 55. So that's the difference between payoff and return. So payoff is what you receive, return is what you make. Okay, so you will always make $5 less than your payoff in this example. Okay, so if let's say the current price is 52, how much you are making? You are making 2 minus 5, so minus $3. Okay, so that's your return and $2 is your payoff. Okay, is this clear? So that ends today's webinar. Any doubts, guys? Anything you would like to ask? Any questions? Anything? Any doubts? Okay. Okay, please clarify the second question once more. Okay, just a minute. So the second question was, assuming the stock price and all other variables remain the same, what will be the impact of an increase in the risk-free interest rate on the price of an American put option? Now it says, what is the relationship between interest rate and American put option, or basically put option? Okay, now the simplest example I try to solve this logically. Logically means is, for example, let's say you have a put option which you have the right to sell at 50. Now, what is put option? What is the basic definition of put option? That you have the right to sell at 50, that you will sell after 3 months or 2 months or 1 month. Okay. Now, one option is you sell now. So you have the stock, you sell it now, or you agree to sell after 1 month, 2 months, 3 months. If you sell now, you will receive $50, right? And you can pocket this $50 here, and now, so you can pocket this $50 now, or you can pocket this $50 after 2 months. So if you pocket this after 2 months, you will lose interest rate on this $50 for 2 months. So if you sell it now, this $50 you can deposit in the bank on the interest rate, or if you sell after 2 months, you will start earning the interest rate after 2 months, right? So the difference between these two is keeping everything remain the same. So it says all other variables remain the same. So keeping everything else remain the same, after 2 months you will get the money. So you are losing interest for 2 months, right? Now, if interest rate is high, would you like to deposit in the bank now or after 2 months? So if interest rate is high, I will definitely try to earn now rather than later. So what I'll do, I'll try to deposit as much as I can now. So if its interest rate is high, how can I get money? I can sell the stock now and earn the interest. Okay, so if it is low interest rate, I don't mind depositing now or later. Okay, so that depends on what's the payoff. So basically, if I own an option, there's higher chance that stock will move in my favor and I'll earn. So it's better to keep the option in case interest rates are low. But if interest rates are high, in case of a put option, I would like to deposit money now because I will earn higher interest rate in the bank now. Okay, I don't know what will happen after 2 months, but even if interest rates remain the same, I will earn for 3 months if I deposit now, and I will earn for 1 month if I deposit after 2 months. So I would like to deposit now. So I will not favor the buying the put option. So see the difference. So if interest rate is high, I will sell now. If interest rate is low, I will sell later. I don't mind selling it later because I have higher chance of making through the put option. So if interest rate is high, I will go for selling now, and I can deposit it in the bank because I will earn extra. Okay, so if interest rate is high, I will not prefer put option. I will sell the stock itself now. So demand of put option goes down, the prices of put option goes down. So if interest rate is high, the prices of the put options are down, they have a negative relationship. Hope this clears your query. Any doubts, please ask me again. So this was a question of Ashish and Christos. Okay, so guys, if you have any doubts regarding this demo class about the offerings of Edu Pristine, or about Edu Pristine, or about the option basic, feel free to email us. Please visit our websites for more details. Our team will be contacting you with the details. So if you don't have any questions, we'll end this webinar here. Okay, I received one more question. So this was the case before entering into the put option. Yes. So basically, see, the prices of any asset or anything we determine by demand and supply normally. Okay, and especially in the case of options. So when we will be studying Black-Scholes and implied volatility, we will be discussing that how we calculate implied volatility with the prices from demand and supply. Okay, so this is the case even if you talk about before entering or after entering, because see, if even if you buy the option, somebody else will not buy. So see, if there are 10 people and 5 options, the price is bound to go up. But if there are 5 options and only 2 people are ready to buy, okay, the price will go down. So it doesn't matter if it is before entering into and after entering into. Okay, no, it is not the case of exercising. See, it says what is the relationship. So the question what Ashish is saying, it was not a case of exercising the put option already entered into. Now it doesn't talk about exercising. If you read the question carefully, it talks about the relationship between put option and interest rate. It doesn't talk about exercising anything. It only says what happens to the option price, put option price, in case interest rate goes up. So regardless of the exercising. Okay, so it's just basically how the price of the put option will behave in case your interest rate goes up. So if interest rate goes up, the price will go down. Okay, so in call option actually it's the opposite, so we might discuss this later someday. Hope this is clear. Any doubts, guys? Okay, hope this is good for you. So in case you have any doubts, please contact us. Okay guys, have a nice day ahead. Take care. Bye.